So, in the last chapter, we talked about where we get the resources in order to acquire the assets necessary to run our business. We said we can get them from investors, and there's lots of different kinds of structures to get money from investors, common stock and preferred stock and so forth. And then we can also borrow money, either from banks, individuals, private placements, or bonds. And the question then becomes, why or how do I decide what I should do? Should I borrow more? Should I get more equity? Is it bad to have debt? Is it good to have debt? And so forth. So now we're kind of getting into the area of capital structure. And this is an area that sort of is part of the finance portion of the course. And so we're going to talk about that. We're going to start out by talking about leverage. So all of us as children used seesaws, I think, form of leverage. We've probably all used levers to move rocks or heavy objects. And levers work, or lever's power comes from where you put the fulcrum, where you put the point where the lever touches the center or the fulcrum. I don't know whether that's the center. I'm not a physicist or an engineer. I think some of you are actually, but I'm not. But we can change the point of leverage, which will give us more power over the object we're trying to move, or we can change it in various places, move it from one point to another. And so we use that same term for financial leverage. And all of us are familiar with this, but we may not understand the ins and outs or why it's good or bad. As individuals, we generally feel better if we don't have any debt. But many of us carry debt for things like house mortgages or car loans and things like that. And that's a form of leverage as well. So we'll talk about how that all works. In the corporate world, there are two kinds of leverage. There's financial leverage, which is what I've just been talking about. How much should I borrow? And as opposed to how much should I seek from my investors, my equity holding. So that's financial leverage. But then there's another kind of leverage called operating leverage. And we'll talk about that as well. And they're both key. And you guys looked at two maritime companies. And I think those are pretty good examples of both the benefits and the dangers of leverage. So we'll pull some of the information from Kirby and Tidewater into this discussion. So financial leverage, here's your definition. The extent to which a firm gets its cash resources from borrowing as opposed to investment debt, as opposed to equity. And the debt to equity ratio, I know your book actually has a typo and calls it debt of equity, but it's debt to equity. And that debt to equity ratio is a key ratio in measuring leverage. And that's also a measurement of solvency. So the more leverage we have, the more risk we have. So the more borrowing relative to equity we have, the more risk we have. And the real trick is to use leverage carefully, but to use it because it provides significant benefits in some ways. So we'll talk about those. The other type of leverage is operating leverage, and this is the extent to which a firm commits itself to fixed costs versus variable costs. So I can own things or I can lease or rent things. If I choose to own things, I have higher operating leverage. And once again, like financial leverage, there's benefits to operating leverage, and there's risks to operating leverage. So think about Tidewater. Tidewater owned a lot of their ships. When times were good, that was a benefit because they had ships available and they could lease them at very high rates to major oil companies. When the market changed and there was less demand, they still owned the ships. And the ships they couldn't lease, or they couldn't lease them at for amounts that were large enough to cover their costs. So they had a problem. They owned ships, but they couldn't utilize those ships, and so therefore they were stuck with the costs of the ships without any of the revenue of the ships. So it improved their earnings when times were good, and it depressed their earnings when times were bad. And that's how leverage works, and the same thing is true for financial leverage. So operating leverage is key, and it's always a decision. Should I commit long term by buying this asset, or should I lease this asset? And every business has to make this decision. If I'm a retailer, I can own my stores, or I can lease my stores. If I'm a manufacturer, I can own my warehouses, or I can lease my warehouses. And the same is true of machines. It's the same is true of boats. The same is true of airplanes and cars and trucks, and you name it. Anything you can own, you can also lease from somebody else who owns it, and not have the ownership responsibility when you don't need it anymore. So let's look at some of those examples. So ownership generally relates to having fixed costs. And fixed cost is one that remains the same at all levels of operations. So going back to Tidewater, the fixed cost of owning those ships stayed the same, even though when times were good, it stayed the same, which was a good thing. So they had revenues went up and their fixed costs stayed the same. But when revenue fell, the fixed costs stayed the same as well. So if you're locked into fixed cost positions, you have operational leverage, and that increases your risk, but it also increases your returns. So risk-return balances, we're going to talk about it over and over again. Risk and return is always the balance. The more risk I take, the more returns I have the possibility of getting, but the risk means that I have the possibility of going the other way, of having risk, of having failure. So first I'm going to give you a simple example of financial leverage, and this is not a corporate example. This would be you. So suppose you invest $100,000 and you make a good investment. You invest it in something that grows in value to $110,000 and in 1 year. You sell it at the end of a year, and your profit on that investment is $10,000, or 10% return on your initial investment. Good. That's a good thing. But let's say you chose to use leverage instead. Suppose you said this same investment, you're confident that this investment is good. So instead of investing $100,000, you invest $1 million. Your same $100,000 of your money, but you borrow another $900,000, and you pay 7% interest for that money. A year later, you sell the investment for $1.1 million, 10% increase in value, just like the above example. After paying back the $900,000 loan and the $63,000 of interest, you're left with $137,000. You made a $37,000 profit on your $100,000 investment, which is a 37% return instead of a 10% return. That's leverage. Most of us have experienced, or many of us have experienced this in real estate, because most of us use leverage when we buy a house. We have a mortgage. That's leverage. We use somebody else's money. We borrow somebody else's money and buy a piece of real estate or a house. And we buy it because we're going to live there, but we all know that we move and so forth. And if the housing market is rising in price, we use that leverage to have an outsized percentage gain. We might put 10% down on the house, but the house goes up 20%, and we make a lot more than 20% on selling the house because we had a very small investment relative to the overall size of the house. So that's where leverage is good. That's a good part of leverage. Here's a little chart that shows the same information. Your capital is $100,000. You have borrowed money of $900,000. You have interest cost of 63. You sell it at $1.1 million. $1.1 million minus $1.063 million, you have a $37,000 gain. for your $100,000 investment. That's 37%. And over here, your 100,000 sell price of 110, 110 minus 100, you have a $10,000 gain or a 10% return. Which return would you rather have? Well, I'd certainly rather have the 37% return than the 10% return. But what's the risk? The risk is that the investment may go down in value. So let's look at that. So you invest $100,000 and a year later you sell that investment for $90,000. The investment declined in value by 10%. Your loss is $10,000 or 10% of your initial investment. You still have your 90, you've lost 10. But if you'd leveraged it the way we did the last time, you invested $1 million of which you borrowed 900 and used 100,000 of your own money. A year later, you sell the investment for 900,000. Use all the proceeds to repay the $900,000. You still have to pay $63,000 of interest. So you lost $163,000, which is 163% of your initial investment. You actually lost more than you had. You had $100,000 and you lost 163. So you're $63,000 in the hole, if you will. So that's the downside of leverage. So when things are good, leverage increases your return. And when things are bad, leverage increases your loss. And that's the downside. So that's the risk side. This is the reward side. And this is the risk side. So just a chart of what happens when I do this. My $100,000 with a $90,000 sell price, I have a $10,000 loss or a 10% negative return on investment. And here I lose more than 100% of my investment. I borrow 900, I have interest costs of 63. I sell it for 900. I have to come up with $163,000, of which I only have 100, so I actually have to pay $63,000 out of pocket, plus losing my entire investment. So there's the downside. That's a really simple example, but that same example, whether it's this one or this one, applies to corporate finance. If I have more leverage, I use more of other people's money, that's financial leverage, I can do really well if I can invest it at a higher rate than I'm paying for it. However, if my investment goes sour, it increases the loss. So the first rule of using other people's money is that it only pays to borrow if the cost of borrowing is less than the rate of return you expect to get. So you never want to borrow money at 4% in order to earn 3%. You never want to borrow money at 7% in order to earn 0%, which is or to lose money actually is what we just looked at. So remember, when you're looking at these things, you need to invest in a way borrow in a way that allows you to get a higher return from your money than what you're paying for it. So who should borrow and who shouldn't? In the corporate world, companies that are very volatile should be less leveraged. They should borrow less. And companies in stable industries can usually have higher leverage safely. So railroads are famous for their stability. Their business increases, their business decreases, but it increases and decreases in small amounts. So they can usually carry a lot of leverage. They can use a fair amount of other people's money and invest in that. Electric utilities are non-cyclical, and electricity demand does not change very fast from year to year. That changes over time with different technologies and stuff, but from year to year it doesn't change very fast. So electric utilities can use a lot of leverage. They can borrow a lot of money relative to their equity. But companies in cyclical areas should be very careful about leverage. So a company like Tidewater, the oil industry is notoriously cyclical. It has huge booms and huge busts. So if you're serving the oil industry, you can assume that there's going to be big booms and big busts. Maybe. I think at the time that Tidewater was doing most of its investing, people said, "Oh, there's a shortage of oil. There's no end to the prosperity in the oil patch. So we're safe making these, borrowing a lot of money and making these using leverage." But that came back to bite them when it turned out that oil is really cyclical, and therefore demand fell, and their investments didn't pan out, and the leverage made it much worse than it might have been if they hadn't used so much leverage. So that's examples of financial leverage. I'm going to stop here, and then we'll ask a question or two, and then we'll go on to operating leverage in the second half of chapter 9. Thanks very much.